Welcome, traders, to another Tickmill trading update with me, Patrick Munley. Want to update the SP500 view using the Emini futures contract and put together a trade plan for the week ahead, looking at some high probability action areas and some price targets that we can realistically expect to achieve. So S&P 500 finished up last week 1.2% for the week, making a new all-time high on Friday, and for the month is up 3.2%, and year to date 13.3%. And Friday's highs also completed a 10x return from the March 2009 lows, so putting in place a bull run now of 16 years. Along with the S&P 500, information technology, financials, consumer discretionary, and communication services also put in new all-time highs as of last week. In terms of the position in the market, the monthly candle is one time framing higher, and that would be negated on a close back through 62.39. Weekly, also one time framing higher, would be negated on a close through 66.11. And the daily is also one time framing higher, 66.87 is the level there to negate that. And in terms of where we are with market breadth, S&P stocks closing over their 20-day moving average was at 46% last week versus 53%, marking the second week of decline there and the first to print under the 50% level since early August. S&P 500 stocks over their 50-day moving average closed at 57% versus 59%, again, second week of decline there. And stocks closing over the 200-day moving average, 60 versus 63%. So we are seeing, or we're certainly starting to get a sense of divergence being maintained here in terms of breadth versus price. In terms of the calendar for the week ahead, we're going to get PMIs from S&P, GDP final comes in, but most importantly on Tuesday, look for a speech from Powell. Probably not going to be too market moving with respect to the fact that he only spoke last Wednesday, and we can't realistically expect his views to have changed materially since then. And the main data release that will be of note will be core PCE at the end of the week. So we can expect volatility as usual to pick up into the latter part of the week. In terms of Gamma, Gamma finished the week at 533, down from 1.1 billion after the quarterly options expiration. This would sense that a good chunk of the options have rolled up and out into the next expiry. So the 6,700 strike seems to be the next big Gamma wall above the market. The Gamma flip now below us would be at 65.57, which is its highest read. In terms of the flows, corporate buybacks should be winding down now. CTAs and vol controls funds remain in a buy a little, sell a lot type posture, but no reason to sell just now. We have passed through, obviously, options expiration, and the market should actually now be a bit freer to move as per the Goldman Sachs update. While not a big Gamma read at that 533, we can assume that dealers will still be buying dips and selling rips, and vol control and CTAs won't really be a factor. The market having the ability to absorb whatever business they have on their books at the moment. So overall, I wouldn't expect a huge change in terms of intraday price action. From the volume weighted average price perspective, moving to the charts now, daily VWAP is sitting at 66.83, bullish print there. And the weekly volume weighted average price on the 5-period look back at 65.87, also bullish. So the structure remains constructive and supportive from a technical perspective. If we move to the intraday time frame, so we're looking at the hourly chart now. This week I'm using the 6600 to 6590 as my weekly bull bear zone. So any test back into that area will be pivotal, and we also have the volume weighted average price anchored against that low that we saw at the beginning of the month, coming in just below there at the moment, so 65, 66, but that will obviously tick higher if price continues to advance to the upside. From a range perspective, this week we're looking at 67.34 as the upside range, potential range resistance. 65.95 is the weekly projected range support versus options implied volatility. So this is why I've set up this area as my bull bear zone. You can also see we have a decent volume node there in terms of the look back periods. And so I would be using any moves back into this area to act initially as support. But for as we head into the start of the week here, I'll be looking at any move into test this little volume node here that we have at 66.70s. I'll be using that as my daily bull bear zone. So 66.70s to 66.60s. Any move in there, we look for buyers to engage. So watching for bullish reversal patterns intraday to set up a test then of that 67.34 as the weekly range resistance. We could see some consolidation from that zone, but ultimately what I'm looking for is a push higher to complete a sequence that I'm going to highlight now. So if we look at this 5=1 objective versus our swing low at the 66.10 area, you can see we're looking for 6779 as a 5=1 objective. Also coincides with daily projected range resistance today and the weekly R1. So I'd be looking at any move into this zone. Watch for bearish reversal patterns there. Certainly if we maintain momentum divergence, so we make new high in price, but we don't get a new high in terms of the momentum study, then that could be the area to look for a fade, to trade back in, ultimately then to test down into our weekly bull bear zone, where I'd be looking for buyers initially to step back in and to get a retest of that 6670 level from below, and then we'll see how price action develops from there. But that's the setup I'm looking at as we head into the start of the week here. As always, after printing those all-time highs on Friday, we can expect a bit of consolidation or a pullback initially to start the week, and then we'll see if we can grind it out to the upside before once again looking for a pullback, like I say, into that weekly bull bear zone. Any loss of the weekly bull bear zone as support would be a bearish development, and the next downside objective would, for me, would be back in to take a look at 65.60, 65.50 as the next potential support zone to the downside. As always, traders, plan the trade, trade the plan, and most importantly, manage your risk. Until next time, thanks very much.